Build your dreams, live rich, and leave rich.
Welcome, everyone. My name is Krish, and here on this channel, we believe something very simple. To live rich is to live peacefully, not lavishly. Today, we're going to pull back the curtain on a really powerful investment tool, one that I believe sits right in the sweet spot of the Indian economy. We're talking about the mid-cap mutual fund. All right, before we get into the good stuff, just a quick but very important note. Everything we discuss here is for your education. Mutual funds do come with market risks, so it's absolutely crucial that you talk to a CBI-registered financial advisor before you make any decisions for your own family's money. When most of us think about investing on Dalal Street, it feels like we're stuck between two really tough choices. On one hand, you've got the giants, right? The big, famous companies. I call them the elephants. They're safe, they're steady, but gosh, their growth is just so slow. And on the other hand, you have these tiny, brand new companies, the cheetahs. They promise you the world, explosive growth that could change your life. But the risk, it's just off the charts. They could disappear tomorrow and take all your hard-earned savings with them. But what if that whole dilemma is just a myth? What if you don't have to choose between boring and broke? What if there's a third way, a perfect middle ground that gives you both stability and that exciting growth potential? Well, that's exactly what we're going to explore. Give me just a few minutes and I promise I will show you the ultimate sweet spot of the Indian economy. You're going to learn how to spot and invest in the rising stars of India, companies that have already proven they're tough survivors but still have a huge runway ahead of them to multiply your wealth. So, here's our game plan for today. First, we're going to bust that investing myth. Then, I'll give you a really simple analogy to understand the sweet spot. We'll peek into the official SEBI rulebook. After that, we'll explore something called the Goldilocks zone. We'll join the manager's hunt to see how these funds are actually built. And finally, my favorite part, we'll celebrate something I call graduation day. Okay, to really get this, let's just forget about the stock market for a minute. Forget all the confusing jargon. Instead, I want you to imagine we're talking about something we all know and love, restaurants. First up, picture a giant global fast food brand. You know the one. It's got branches in every single city, all around the world. It's a household name, it's stable, it's predictable, and it's definitely not going out of business. But let's be real. Its best growth days are way in the past. It's just too big. Well, that right there, that's a large cap company. Now, let's go to the complete opposite end. Think about that trendy new food truck that just opened up downtown. The food is incredible, there's a huge buzz around it. Everyone's talking. Now, this little truck could become the next big thing, a national sensation. But it's also walking a tightrope. One bad month, a little too much competition, and poof, it could be gone forever. That's a small cap company for you. Huge potential, but oh, the risk is so high. But now let's talk about the restaurant in the middle. Imagine a super successful restaurant chain. Maybe it started in the South and now has 50 branches, and every single one is always packed with happy customers. They've proven their business model works. People love their food. They've totally cracked the code. And now they're ready for the big leagues. They're raising money to go from 50 branches to 500 all across India. They've already proven they're a success, but their biggest growth story is just getting started. That is a mid-cap company. Now, this is really important. The term mid-cap isn't just some cool marketing phrase. Here in India, it's actually a very strict official definition that's set in stone by our market regulator, SEBI. And this is fantastic news for us as investors because it gives us total clarity. The rule from SEBI is actually wonderfully simple. They just say, let's line up every single company listed on the stock market, from the biggest to the smallest. And how do they measure size? By something called market capitalization, which is just a fancy way of saying the company's total price tag. Now, according to SEBI's law, the 100 biggest companies are large caps. But the companies that are ranked from number 101 all the way down to number 250, those are officially our mid caps. It's an exclusive club of 150 rising stars. And SEBI didn't stop there. They made another rule that is designed to protect you. If any mutual fund in India wants to call itself a mid-cap fund, then it is legally forced, it's not a choice, to invest at least 65% of all the money you give it directly into companies from that 101 to 250 list. This rule is non-negotiable. It means when you invest, you know exactly what you're getting. Okay, so what's so magical about this particular group of companies? Why is this the sweet spot? Well, it's because this is what savvy investors call the Goldilocks zone. You know the story. It's not too hot, not too cold, it's just right. This is where it all comes together. Look, large caps give you that stability, but the growth potential is pretty low. Small caps offer huge growth potential, but their stability is shaky. A bad economy could knock them out. But mid caps, they give you the best of both. They have real stability. Remember, even the 250th company in India is a massive business worth thousands of crores. It has the financial muscle to survive a crisis. And at the same time, it has sky-high growth potential. These companies are hungry, they're nimble. They can grow their profits by 20, 30, maybe even 50% in a good year, something the giants can only dream of. Now, I need you to listen to this part very carefully. This is absolutely critical. Because these companies are growing so fast, their journey on the stock market can be a bit of a roller coaster in the short term. So let me be very clear. This is not a get-rich-quick idea. To really capture the benefits of this amazing growth, you have to think long-term. This is money that you need to be prepared to lock away for at least 5 to 7 years. That gives these amazing companies the time they need to grow, and it allows you to ride out the bumps without panicking. So we have our official list of 150 companies. But how does a fund decide which ones to actually put your money into? I mean, they don't just buy all of them, right? No. This is where the skill and the art of something called active management comes into play. And it's a completely different game from just buying an index. Think about it this way. A passive fund, like one that tracks the Nifty 50, is basically on autopilot. A computer program just buys all 50 companies on the list, no thinking required. But an active mid-cap fund, that's run by a real human expert, a fund manager. Their job isn't to buy all 150 companies, no. Their job is to be a detective. They have to hunt through that list of 150 and find the 40 or 50 hidden diamonds, the companies they believe have the absolute best chance of becoming tomorrow's superstars. And let me tell you, this hunt is serious business. The fund manager and their team, they dig deep into the numbers. They're checking balance sheets, making sure the company is strong and isn't drowning in debt. But it goes so much further than that. They get on planes, they go out and meet the CEOs, look them in the eye, and try to understand their vision for the future. They'll even go visit the factories to see with their own eyes how things are running. What they're looking for are those special situations, maybe a great company that's just had a tough year and is about to turn around, or a new leader in a brand new industry that nobody's even paying attention to yet. And this brings us to my absolute favorite part of the story, the grand finale. So what happens when that fund manager is right? What happens when their hunt pays off and they find a real winner? Well, this is what I call graduation day, and it's the beautiful, powerful engine that just keeps creating wealth for you over time. Just follow the journey here. Let's say our expert manager finds a fantastic company ranked way down at number 180. They do their homework and they invest. Over the next few years, the company does everything right. Its profits explode, its value on the market skyrockets, and before you know it, its rank climbs and climbs until, boom, it breaks into the top 100. It has officially graduated and become a large cap. Now, this is key. The fund manager does something smart called rebalancing. They will sell that winning stock, locking in those huge profits for you, the investor. And what do they do with that cash? They go right back on the hunt, looking for the next promising company at rank 180 or 200. And the whole amazing cycle starts all over again. All right, we've covered a ton of ground. Let's do a quick jargon bust so these terms stick. First, market capitalization. Super simple. It's just the total price tag of a company on the stock market. That's it. Next up, active management. This is just when a smart human expert, a fund manager, is actively doing the research and handpicking what they believe are the very best stocks for you. And then we have rebalancing. That's just the smart habit of selling some of your big winners, taking those profits, and using that cash to buy new opportunities to keep your whole strategy on track. And finally, the Nifty Midcap 150. Think of this as the official report card. It's the stock market index that tracks how all 150 of those mid-cap companies are doing as a group. So there you have it. I really hope this deep dive has given you a much clearer picture of how powerful mid-cap funds can be as an engine for creating wealth over the long run. If you found this helpful, do me a favor and hit that like button and subscribe for more explainers like this. And don't forget to check out the Legacy Diary in the description below. Thank you so much for your time. Live rich and leave rich.